Want to know Wall Street's best-kept secret? It involves a simple ratio and a company's inventory. Discover how analyzing inventory turnover can predict a company's true health and future stock price, and potentially help you generate wealth. Learn the fundamental analysis basics and turn those insights into investment gains. So you want to pick stocks like a pro. It all starts with something called fundamental analysis. It's like being a detective for companies, looking at all the clues to see if their stock is a good buy. First, we look at the company's financial statements. Think of these as the company's report card. The income statement shows how much money the company made, revenue or sales, and what it cost them to make it, COGS. Gross profit is what's left over. Operating expenses like SG&A, selling, general and administrative costs, and R&D, research and development, are subtracted to get operating income. Then, interest expense and taxes are taken out to find the net income, which is the profit after everything. Earnings per share, EPS, tells you how much profit each share of stock gets. Next up is the balance sheet. This shows what the company owns, assets, and what it owes, liabilities. Assets include things like cash, accounts receivable, money owed to them, and inventory, stuff they haven't sold yet. Liabilities are things like accounts payable, money they owe, and debt, both short-term and long-term. Equity is the difference between assets and liabilities. It's the company's net worth. The cash flow statement tracks where the company's cash is coming from and going. There are three main sections: operating activities from their regular business, investing activities, buying or selling assets, and financing activities, borrowing or paying back money. Free cash flow is a key number, showing how much cash the company has left over after paying for its operations and investments. Now, let's talk ratios. These are like shortcuts for understanding the financial statements. The gross profit margin, gross profit times revenue, shows how profitable the company is on each sale. The operating margin, operating income divided by revenue, shows how well it's controlling its expenses. The net profit margin, net income divided by revenue, shows the overall profitability. Other important ratios include return on equity, ROE, return on assets, ROA, and return on invested capital, ROIC. These show how well the company is using its money to make profits. The current ratio, current assets over current liabilities, and quick ratio show if the company can pay its bills. The debt-to-equity ratio and debt-to-assets ratio show how much debt the company has. But it's not just about the numbers. You also need to look at the company's industry and the overall economy. Is the market size growing? What are the industry trends? Who are the major competitors? Competitive landscape. Is the company at a competitive advantage? Things like GDP, inflation, interest rates, and unemployment rate can all affect the company. Finally, think about the people running the company, management team, their corporate governance, and the company's brand reputation. What's their business model? Are they innovative? Remember, fundamental analysis isn't a crystal ball. It's just a way to make informed decisions. Always consider the risks, like financial risk, operational risk, and market risk. Diversify your investments to spread out the risk. Think about your own risk tolerance and time horizon. The investment strategy of each individual is different. We touched upon various topics, but certain tools like discounted cash flow, DCF analysis, or deeper dives into specific industries were not covered in this video. Exploring these areas can further enhance your stock analysis skills. If you found this helpful, please like, share, and subscribe for more videos like this.